Well, hello. My name is Anthony Sicaro. I'm founder and president of Providence Financial and Insurance Services, located right in the heart of the San Fernando Valley in Woodland Hills, California. I'm also host of the Providence Financial Retirement Show, which airs every Saturday on AM 870 KRLA The Answer. And you know that periodically I like to do these videos when the economic conditions change or when there is important information that I think I want to relay to you. And that certainly is the case today because the stock market officially entered bear market territory. Now, of course, it had to do this on Christmas Eve, so it's December 24th, 2018, which is why I'm recording this from my home office. I didn't want to wait until next week when I get back in to get this information to you. And, these videos are primarily for my clients. So if you're a client of mine, thank you for your business. Thank you for your trust. And if you're not a client of mine, then you're welcome to watch. And certainly if you have any questions about anything I talk about, then feel free to contact us. And all of our information is on our website at providencefinancialinc.com. Well, there's two purposes for this video. The first purpose is because a number of our clients are waiting for a better time to get back into the stock market. And, the question that we've had from a few people is this a better time? So we're going to take a few minutes and we're going to talk about that. The second reason for this video is because we've gotten a lot of questions from our clients, questions that have their money invested with us, questions about investing for income. Matter of fact, almost all of our clients' accounts are down. The market's down at this point by 20%. Every asset class is in the red unless you have money just sitting in the bank, not earning anything. So we've gotten to clients. Is my money still safe? Is it protected? So I wanted to just take a few minutes and remind you of how we have you invested, maybe come at it from a little different angle and let you know that this is not unexpected. If you've watched any of my videos or you've come to our client appreciation events, then you know that this is very expected. This is why we have you invested. So I just want to take just a few minutes and remind you of that. Well, let's talk first about, is this a good time to get back into the stock market? A number of our clients are waiting for a better time to get back in the market. They've got a certain amount of money that they would like to have in the market, and they just didn't want to get in at a higher level. Wall Street basically says just get in whatever it is and ride it out. And, my question is if you want money in the market, why would you get in when the market's at record highs? Why not wait until a better time to get your money in? If you get your money in at record highs and you ride it out for 30 years, you'll probably be glad you did that. But if you get your money in at a lower level and you ride it out for 30 years, you'll be even gladder that you did that. So it just makes sense to buy in at a better time. So the question is this a better time? And certainly it's better than it was 2 months ago because the market is now down 20%. An official bear market occurs when the market is down by 20% from a recent high. And that's where the S&P 500 just crossed into today. Now, wouldn't it be nice if we had a crystal ball that told us where the bottom was going to be? That would be splendid. It doesn't work that way, right? In 2008, the market had a heavy crash. That crash went from 2007 down to March 9th of 2009. The market crashed by over 60%. And the bottom line is that March 9, 2009 was the all-time low. Well, we didn't know in May of 2007 that March 9th was going to be the all-time low and that the market was going to be down 63%. We didn't know that, so we couldn't say, well, let's wait till March 9th. And right now, here we are, 20% down. Are we going to go down 40 more percent? Are we at a bottom now and the market's going to rebound and you're going to wish you to put all your money in the market now? We don't know. Now, for those of you that are invested for income, we don't care. That's the nice thing. I'm going to talk about that in a second. But for those of you that want to put some money back in the market, we don't know. So here's the strategy. Here's what I would recommend. And that is that you dollar cost average back in the market over a period of time. And all that means that you don't try to time the market. Market's down 20%. It doesn't mean you try and take all your money and put it in the market now, because if the market goes down another 20% or more than that, then you're going to wish you had some money set aside. Here's the thought process I would be having if I were you and you want to get some money back in the market. You want to kind of take a look at your portfolio. You want to kind of figure out how much do you want to have in the market? What's the total dollar amount or what's the total percentage of your portfolio you want to have in the market? And then I would divide that by maybe 5 or maybe 20% segments. And then maybe you put well, I would take those 20% segments and I would kind of calculate when should I put those in the market. Maybe you take the first 20% and you put it in the market now. We're down 20%, so maybe you put 20% of the maximum you want in the market now. And then if the market goes down a little more, then you put another 20%. Market goes down a little more, you put another 20%. So maybe that's how you do it. And that's the whole process of dollar cost averaging back in. Now, we don't know where that uptrend is going to be. So if you put 20% in now and the market goes up, maybe you put another 20% there. The bottom line is I don't think you should be putting the whole thing in now because I think we have a long ways to go. But that's what I would be thinking. Figuring out what the total amount you want to have in the stock market is, dividing that by, it could be 5, could be 10. Maybe you want to put in 10% of that number at a time. Maybe you want to put in 20% of that number at a time and getting back in over time. That's what I would be thinking. Now, where could the market go? I think it could go a whole lot lower than this. I've got videos on this going back the last few years. I'd recommend you watch those videos. And it's going to be different watching it this time because this is what we've been saying for the last 3 or 4 years is going to happen. We kind of know it's going to come to an end at all the good times, but we don't know how far. We don't know how deep. We didn't know when, certainly. But the market can go down very quickly. It's taken a month and a half or two to get down 20%, and it could come back just as quickly. So I think it's important to understand that. So if you look at where the market could go, just very quickly before we move on, and that is that, I think a good indicator of that is price to earnings ratios. Price to earnings ratio has to do with how expensive the market is. And, the average price to earnings ratio over a long period of time is 15. Well, right now, price to earnings ratios are kissing 20, the ratio of 20 at this point. So the the Dow Jones really has to come down to about 18,000 to get to its average. Now, there's nothing magical about the average that's going to stop right there. The average of something means that sometimes things are going to be overvalued and sometimes things are going to be undervalued. But I do think that the Dow Jones has the ability to get down to 18,000. Am I right? Who knows? I don't have a crystal ball. We don't know. But I think there could be, another 20 or 25% drop in the market from here just to get back to average. So hopefully that helps. If you're thinking about repositioning some of your money in the market, I'm not sure that I would just do it on your own without consulting with me. I would love to talk to you. I'd love to look at your situation. Everyone's different. Don't take this as general advice to put 10% or 20% of your money in the market. But if that's a thought of yours, you want to have a conversation about that, call me. Call our office, set up a client review with me. Again, it's Christmas Eve 2018. I'll be back in the market January 3rd. Not in the market, I'll be back in my office January 3rd. And of course, we can schedule a call or depending on both of our calendars, I'll be more than happy to do that. So end of the first topic. Should you get money back in the market at this point? Wanted to give you some things to think about because we don't know the answer for sure. But let's talk about the second topic. And that is what most of you may be watching this video for. And that is because there's a lot of questions that our clients have had. Let me glance at a couple of these things. A lot of questions that our clients have had. A number of clients have called and said, hey, market's down, my portfolio's down, and I thought you had our money protected. And there's some people that are just worried about what's going on. And I want to take a few minutes and address that. And first of all, your portfolios are protected, but I think that needs to be defined. With every single one of you that we've had this conversation with, and we've talked about investing for income, with every single one of you that have money invested for income, outside of annuities, outside of the bank, that money's protected, money in the bank, money in annuities, it's not going anywhere, that's safe and insured. But outside of those, money that you have invested with us is going to fluctuate. Your portfolio is going to fluctuate. And it's funny, I've had this conversation with every single person that we've ever set up a portfolio with. It's going to fluctuate. And sometimes people think fluctuation means, well, it's just going to fluctuate straight up. Well, we know that's not the case. Fluctuation means up and down and fluctuation over time. And this doesn't happen just over a period of 2 days or 5 days or a year. This could be a longer trend of, fluctuation. And yet you're invested for income, so the fluctuation doesn't affect you. And, again, we've talked about this. I've got videos on being invested for income. I'm not going to take a long time and go over all the details. I've got videos on that, but I do want to take a few minutes and just refresh your memories of of investing for income and how it works, and maybe give you a couple of analogies that you might have heard or you might not have, and maybe expound on them, because it is a difficult concept to understand. I mean, people understand that when you're invested for growth, you buy a stock or mutual fund and you can make a lot of money and you can lose a lot of money, and it's just part of the game. I had someone the other day say to me, well, I expect my account to go down if I'm in the stock market. But when you're invested for income, some people aren't expecting that their accounts are going to go down, and yet they are. And it's we've talked about this, and the reality is that it's different for us to have a conversation in their office talking about your portfolio is going to fluctuate, could go down 10% or more, and it's different to hear that and then actually see it happen. It's almost like saying, yeah, for $1 million, I'll get in the ring with Mike Tyson. I could take a couple of punches with Mike Tyson if you're going to give me $1 million to do it. And then you get in the ring and then you get punched by Mike Tyson and you go, whoa, what am I in for? I had no idea it was going to hurt. And so I think it's along those lines. I think what's happening is, a lot of our clients' portfolios, matter of fact, maybe all of them, are down to some degree because of what's gone on in the market. And now all of a sudden what we've heard and what we've talked about in the office is reality. And it's like, okay, what do we do? Are we still on track? And I think I want to just take a minute and talk about, are we still on track? And I can't do that without reminding you of our overall investment strategy. The overall investment strategy is that we're invested for income. What that means is that you're invested for dividends and interests in your portfolio, so that regardless of the value of your portfolio, your income is going to wind up staying the same. So if you have a $1 million portfolio and you're getting $50,000 a year of interest and dividends, well, you can spend that $50,000 a year in and year out, and yet your $1 million is going to fluctuate. Sometimes it's going to go up, sometimes it's going to go down, it's going to fluctuate. But the $50,000 a year is going to stay consistent. And that's why we're investing the money. So let me ask you, if you have a $1 million portfolio and you're living on $50,000 a year, how much does the fluctuation of that portfolio affect you? The answer? Not at all. It doesn't affect you at all unless you sell. That's the key. But if you're invested for income and you're living off your $50,000 a year, then that fluctuation doesn't affect you at all. And that's important. But think about it like a rental, home. I've used this analogy a lot because I think it's a fantastic analogy. It very much illustrates how our clients' monies are invested for the most part. Imagine you have a $1 million rental home. And imagine that rent's paying you $50,000 a year. Well, if that $1 million rental home, if that home dropped to $700,000 or $600,000 or $500,000, as long as your $50,000 a year comes in, does that drop really affect you? The answer is no. It doesn't affect you at all. And yet, again, we don't like to see it. You'd never buy a home at $1 million knowing that it's going to drop to $500,000. You'd wait for a better time. But the reality is again, we don't know when is a good time, when is a bad time. So the fluctuation of your portfolio is just going to be a natural consequence of having your portfolios invested in the moderate category. And that's where your monies are if they are fluctuating. Now, sometimes we've had people say, well, I've been reinvesting my money. I haven't been taking the income. So what happens when I reinvest my money, and what does this look like? And I think that's a great question because, some of you that have been invested for a year or two, or maybe even longer, your portfolios are looking like the same value as they were maybe a couple of years ago. And the reason that is because your share price is coming down. What we've protected is we've protected the number of shares. If you started off with X amount of shares, you still have X amount of shares, because regardless of whether you're getting your income or regardless of whether you are reinvesting your income, your shares are staying the same. So the shares may have dropped, and when the shares come back, then you'll wind up rebounding to the full value that you had before when the price comes back, because we didn't have to sell shares. So we're protecting your shares, even though the value of each share is going to wind up changing and having gone down over the last couple years. So your share price has dropped, but the number of shares is still intact. So what about this income if you're not spending it? What's happening? Well, we're taking this money and we're reinvesting it. we're reinvesting it. So what we're doing is we're buying more shares. And that means that when the share price comes back, you're going to have more shares. So your portfolio is going to wind up being worth even more by the time the share price gets back to normal. And let me illustrate that. I understand it because I've had some conversations with some of you this last couple of weeks. And I know how difficult it is to understand. So let me maybe try to do it in two steps. Okay. In your portfolios, you've got a cash account, some money market account. And that money market account is where all the dividends and interest go until we reinvest it for you. So let's go back to our rental analogy. Let's say that you have $1 million home. And let's say it's giving you $50,000 a year of rent, but you're not spending the rent. You're just taking it and putting that rent into a bank account. Okay. And let's say that, that over the next, let's say that over the next 10 years, and that the market drops and recovers. Now specifically for our analogy, I'm talking about the real estate market. Let's say that the real estate market drops for the next 5 years, and over the following 5 years, it recovers. Oftentimes, when you look at a significant bear market, whether it's real estate or whether it's stocks, oftentimes they last 6 to 9 years, where a drop and recovery could take 6 years, could take 9 years. That's how often long they last. So let's just go on the extremes, and let's say that the house in our example, the $1 million property, drops and recovers over a period of 10 years. So let's say that the $1 million property drops 10% a year for 5 years, and then it comes back over the next 5. So year one, you bought your property at $1 million. Year one, your property dropped to $900,000. But you got $50,000 of rent, and you put that $50,000 in the bank. Year two, your property dropped to $800,000, and you got another $50,000 of rent, and you put that in the bank. And year three, $700,000, and year four, $600,000, and year five, $500,000. And you're looking at your property, freaking out, realizing that I've just lost half the value of the property. But meanwhile, you've put $50,000 a year in the bank for 5 years, so your property's gone down $500,000, but you've got $250,000 in the bank, right? So really, there's a net loss there of $250,000 because you've lost $500,000, but you put $250,000 in the bank. Hopefully, you follow the math. So you might look at that and go, "Oh, horrible investment, horrible," because I've lost $250,000. But you and I know that when you're looking at real estate, that's not the right way to analyze it, right? Unless you think that real estate is going to stay down there forever. That would be the only time that you could really look at it that way, and you could really look at it and say, okay, well, I'm down $250,000 and I've lost $250,000. Unless you think the real estate's going to be there, or unless you sell it there, that's just a paper loss, right? Paper loss. Your income is still coming in, that $50,000 a year. So let's say that over the next 5 years, your $1 million property gets back to $1 million. It just gets back to even. It was worth $1 million 10 years earlier. It's worth $1 million 10 years later. But meanwhile, you've taken that $50,000 and you've put it in the bank for 10 years. That's $500,000. So 10 years later, your $1 million home is worth $1 million, but you got $500,000 in the bank. That means your $1 million home has become worth $1.5 million. Does that make sense? I hope it does, because that's what's happening with your portfolios. Now, could they drop 50%? I don't have a crystal ball. I don't know. In 2008, when the market was down 60%, a lot of portfolios dropped 30 and 40 and 50%, but they all came back. And as long as you're living off your income, or as long as you're saving your income and reinvesting your income, it doesn't matter. The worst thing you can do would be to sell your home when it's at the bottom, especially when it's giving you income. So I hope that analogy helps, because it's one thing to be told that your value is going to fluctuate. It's one thing to be told that your balances could fluctuate by 5 or 10% or 15% or more. I mean, we don't know, but it's one thing to be told that. It's another thing to all of a sudden have the market come bearing down, have the market crash by 20%, get into a bear market within the last couple of months, and see your portfolio go down, and all of a sudden wonder whether this is the right strategy or not. Your shares are still protected. Your money is still protected. You're still getting your income coming in year after year after year. And that's why we've invested your portfolio. Okay? Now, here's the silver lining in the clouds. Not only do you get your income, but if real estate is down, if that home is down by $500,000 and you've lost half the value on the home, like we talked about, wouldn't it be smart to take some of your income and go buy another home? It might be difficult to do because it's so emotionally entangling, like, oh my gosh, the real estate market just crashed. I don't want to buy another home. But wouldn't that be smart to take some income and go buy another home? We know the answer is yes. So when that home comes back, then now all of a sudden you have two homes that come back. And that's what we're doing precisely with your portfolios. Your share price is dropping, but as that share price drops, we're going to be reinvesting. So you're going to be getting more shares. So when the share price comes back, your portfolio will be worth more than it was before it dropped because you have more shares. I hope this has helped. I'm just trying to help you understand what's going on. Again, this is a conversation I've had with each and every one of you who is a client of ours, who has some money invested, and yet a lot of your portfolios are down. It's not unexpected. And hopefully this helps it make sense. We've known this is coming. We didn't know how far, we didn't know when, we didn't know how bad. We still don't know how bad it's going to be. I think we still have a long ways to go. We don't know. But this is why we have you invested. This is not unexpected. Your money is protected. Again, don't hear me say that your share price is not going to go down. Your shares are protected. Your principal is protected. The only thing there's really only three things that could affect that. One, if you sell down, then it's not protected anymore. You locked in the loss. I think it's the worst thing you could do. But you could, certainly up to you. Don't panic. I'll help you keep from panicking. So if you sell early, then you lock in your losses. The second thing is if all your companies went bankrupt, what's the likelihood? We've got you invested in very good companies. Not all going to go bankrupt. That'd be the second option. Or three, if you think that your investments are just going to stay down forever. What's the likelihood? Is this, can I guarantee anything? No. Is it likely that, 10 years from now or 5 years from now, your investments are going to be not likely at all? Those are the only three possibilities. History has told us that the investments always come back. Meanwhile, you're getting your income along the way. I feel like I've almost beaten a dead horse to some degree. I just want to make sure you understand that this is not catching us by surprise. This is why you're invested. If you have any questions about your portfolios, or if you are concerned, or you want to, make sure that for you it's still the right thing, or like we talked about earlier, if you want to, maybe get some money in the market, maybe you do want to take a little bit more of a risk at this point when the market's down, then call me. Call my office. Again, it's December 24th, 2018. I'll be back in the office on January 3rd. My office is going to be open between Christmas and New Year's on the non-holiday days. So you can always call and someone will schedule time. And if this is really urgent, and you call and you leave a message, I'll get the message, or email me. Better yet, email me, and I'll find time to call you over the holidays, and we can have a conversation about this. I'll be more than happy to do what it takes on my end. So I think that's it. Merry Christmas, and God bless, and look forward to talking with you all next year. Happy New Year.